So many of you may recall the original Secure Act that was passed at the end of 2019 and a couple of key provisions that were included. The first was addressing RMDs, previously required to begin at age 70 and a half and now extended to age 72. RMDs are required minimum distribution. When you have certain retirement accounts, the IRS requires you to withdraw money periodically from your retirement. If you are unsure what RMDs are or what they mean, text me at 424-466-8488. Now, the second key provision under the original Secure Act was the elimination of the stretch IRA. The inherited IRA could be distributed over the life expectancy, not of the original account owner, but of the beneficiary, providing an elongated compounding and distribution period. Unfortunately, that was eliminated as part of Secure 1.0, requiring non-spousal beneficiaries to take distribution of an inherited IRA over a 10-year window of time. So, what are some of the new provisions that are included in 2.0 that continue to improve that opportunity to set up a secure retirement for all Americans? The first is the extension of RMD age from 72 to 73 and eventually age 75. That extension is providing an additional compounding and wealth creation to your retirement fund, and that is awesome. That increases longevity for many retirees. The second key provision are catch-up contributions available to those individuals or plan participants age 50 and above. The current catch-up provisions in the year 2023 are $7,500 for 401k plans and $1,000 for IRA owners. These are additional contribution limits above and beyond the traditional contribution amounts afforded to that unique cohort of age 50 and above. And there's an even accelerated opportunity for those individuals age 60 to 63. The catch-up contribution will be $10,000 or 150% of the current year's catch-up contribution limitation, giving retirees an even greater opportunity to accelerate retirement planning. All of these numbers will, of course, be indexed for inflation on an annual basis. Now, whether you are between 50 to 60 or above 63, if you are thinking about taking advantage of those catch-up contributions, but you're unsure how to do it, just text me at 424-466-8488. There was also another change to the Roth account universe. It's the idea that Roth 401k plans are now afforded the same privileges as Roth IRAs. And that's meant to avoid required minimum distribution regardless of age and to provide an even greater opportunity to compound wealth on a tax-free basis. Guess what? Starting in the year 2025, newly established plans will be required to establish plans with a 3% required automatic enrollment or different opportunities for the employees, starting at 3%, automatically rising at 10% with a maximum limit of 15%. The Qualified Charitable Contribution, or QCD, is another key provision that has been enhanced under Secure 2.0. You probably remember the original QCD opportunity. It's available for individuals aged 70 and a half and above to take a distribution from their qualifying plan, and instead of distributing those dollars to their own taxable account, increasing the AGI and all the negative consequences of that increase, they can instead redirect those dollars directly to a qualifying charity. The maximum contribution is $100,000. That $100,000 limitation will be indexed for inflation on an annual basis. Now, there's a second new provision with the QCD, and it's a lifetime opportunity of $50,000 that can be redirected from your retirement account to one of two split interest vehicles, either a charitable reminder trust or a gift annuity. And these as a way of retaining additional benefit from these redirected dollars. Keep in mind that the income paid from these charitable vehicles must revert back to or be paid to the original account owner of the spouse. Now, what about the 529 plans? What about the individual who has accrued additional dollars in their 529 plans? And what about the new provision? Well, a new provision under Secure 2.0 allows individuals to redirect the unused 529 balance into a Roth retirement account for the intended beneficiary. This limitation is capped at $35,000 annually, and the amount that can be rolled in this matter is capped at the annual Roth contribution limit less any traditional Roth contribution made in that calendar year. So what are some of the planning opportunities that future retirees might consider given these new rules and regulation? Well, maybe the most obvious is the Roth conversion opportunity. I know that 10 years ago, many of us took the advantage of the potential benefits and cost of the Roth conversion, moving money from a tax-deferred account into a tax-free account. And by making the conversion and paying the current taxes on that lesser balance, what we were received in exchange was tax-free growth and avoidance of RMDs. The Roth conversion makes tremendous sense given these unique opportunities and enhancements. The qualified charitable distribution should be revisited as a way of fulfilling your charitable intent. So many are trapped in an environment where they are required to take minimum distribution beginning at age 73, and they have to report to the IRS as ordinary income from this distribution, paying more taxes. But now there's a way to avoid that. And these same individuals are fulfilling their charitable intent by making a contribution to charity in the same years. As we know, many individuals making this charitable contribution may not be deriving an associated tax benefit due to the increased standard deduction that is available. As a reminder, charitable contributions provide a tax benefit only under the circumstances under which an individual itemizes their deduction under a Schedule A. But by combining these two functions into one, the distribution from your retirement account and the contribution or donation into an intended charity, you can receive the associated benefit regardless of your itemizing status. And then maybe the final opportunity is to revisit your beneficiary designations. So many of us in our estate planning endeavors name equally a number of intended beneficiaries. That's probably our children. But let's revisit this opportunity considering now the requirement of a non-spousal beneficiary to take distribution over a mandated 10-year period of time. Maybe consider leaving Roth account traditional brokerage assets to your higher marginal bracket beneficiaries and designated taxable events taxable assets such as traditional IRAs or 401k to intended beneficiaries who are the lower marginal bracket. The division of assets can be big, and the tax consequences over an intentionally selective methodology may lower the total tax bill paid by all beneficiaries. I hope that review has been helpful to you. If you'd like to learn more about the Secure Act or any other of the advanced wealth planning strategies, text me at 424-466-8488, and I see you in the next video. Bye-bye.